I think the biggest thing about the RBA cutting rates will be the currency. That's what they'll be targeting. We still have around about 175 basis points of carry comparative to the US on the Fed versus RBA. So there's a lot of carry, and if you look at Japan and Europe, we're a standout. We've got AAA rated nation, and we get some good yield on our deposits. So why wouldn't foreign investors come and play in this market? You see the Aussie dollar stubborn at 70 odd cents. It does not want to go lower. I think if the RBA come into play, it'll be more targeting that currency. We're effectively in a currency war around the globe at the moment. Back in the Asian crisis, it got to 48 cents. That stabilises the economy because you start to see capital coming back in here because we look cheap. At the moment, I would imagine Australia doesn't look all that cheap comparative to where we should be and we have been in previous cycles. Well, I mean, they've been looking at employment, but that is, ABS data is shambolic at best. I mean, they've filled up an MCG and an SCG over the last part of last year. No one believes that data. So I think we'll probably see maybe a give back in some of the employment data coming forward. Obviously, inflation is a big one for them. It was there or thereabouts in the last print, but with oil coming off and deflationary pressures from China and emerging markets and commodities, I think that there'll probably be some pressure on inflation, and therefore that will give them the scope to cut.